so you don't have to take a lot of notes. Then there's that recording starting. So on that note, we will get started with our information webinar. And so we have some really great presenters here for you today. So some of my colleagues from Chicago booth, Maria will be presenting a little later on, and she's from our enrollment team. Rekha, Maya, and myself are from the program delivery team. So you would get to interact with us a lot during the program week when you're on campus. And then we have Professor Douglas Skinner joining us today as well. So a really great group. So we will start with the history of why the University of Chicago booth has an esteemed reputation in the business education landscape. Next, we will discuss the accelerated valuation program, and Professor Skinner will provide a mini case example so you can feel like you're in one of their classrooms. After that, we'll talk through the AVP application process and the program benefits. Then my colleague Maria from enrollment will discuss our Global Advanced Finance program, another exciting opportunity you all have available to you too. And we'll end the information session with a question and answer session so that at that time, ask any questions that weren't addressed during the rest of the presentation. So again, feel free to send questions if you have them throughout the presentation. So now I would like to introduce our faculty presenter of the evening, Professor Douglas Skinner, who is the Deputy Dean for Faculty and Sidney Davison Distinguished Service Professor of Accounting. He is a leading expert in corporate disclosure practices, corporate financial reporting, and corporate payout policy. Professor Skinner's research has been published in numerous accounting and financial journals and featured in major news publications as well. In 2010, Professor Skinner was named one of the top business school professors in the world in the Financial Times Global MBA rankings. Professor Skinner has taught in all of our degree programs, from full-time to part-time to executive MBA and PhD. He also teaches in a number of our executive education programs. At this time, Professor Doug Skinner will share a screen to talk more about the AVP program and to provide you with a mini case study. Doug, you're still on mute.
Got it. Welcome, everyone. Very happy to be here. I am the faculty director of the program and want to take this opportunity to give you a little more information about the program. And before I do that, I want to give you a little bit of information from a personal standpoint, actually, about why the University of Chicago, including why I'm here, and then more specifically about economics and finance at Chicago booth. So let me go ahead and share my screen here. So as I mentioned, why am I at University of Chicago and Chicago booth? Well, I think it's because many of us, meaning academics, are really interested in finding answers to questions. The University of Chicago, I think, almost uniquely among major universities, is really focused on its intellectual mission. Previously, I spent a good part of my career at University of Michigan. I loved Michigan, but for those of you who know anything about college athletics, Michigan also has a major athletic program. What we see on the screen here is a picture of, at the top there, Enrico Fermi. Enrico Fermi won the Nobel Prize in Physics in 1938. But perhaps more famously, as we can see here, he became involved from 1942 to 1945 in the Manhattan Project. And one of the most iconic parts of University of Chicago history is what you can see down the bottom there, which was the first controlled nuclear reaction, which happened here on our campus. I'm on the campus here in Hyde Park, and it happened below the football stadium. And the reason that's relevant is because the University of Chicago is all about answering important intellectual questions and not being distracted by other things like football. So at the time, they decided that it was much more important to figure out how to get this nuclear reaction going which ultimately they did in 1942 right here on campus. But it really speaks to what the university is about, which is asking and answering important questions. So if we go and we think about economics and finance at the University of Chicago, we have, I think, on our faculty have had 9 or 10, depending on how you count them, Nobel laureates in economics. And when I think about what distinguishes our business school here, it's about really the same thing. It's about getting answers to important economic questions. And the way we do that, the way we answer questions, is we develop theory. We then test that theory with data, because without testing the theory to see if it's applicable in the real world, it really isn't relevant to business problems. And that's what we're all about. If you think about some of the most important foundations of modern finance, including the valuation that we're going to be talking about in this program, a lot of them rest on some ideas that were developed here by some of the people who have won Nobel Prizes for the work on our faculty. So to give just 3 examples here, the first one is the famous Miller and Modigliani theory of capital structure, which in some ways is foundational to the way we think about value and the way we think about valuation. I'm going to talk more about Gene Farmer. Gene is, of course, still on our faculty, won the Nobel Prize in 2013 for his work on market efficiency. And then we have Fisher Black and Myron Scholes. Fisher and Myron were PhD students at Booth in the late 1960s. And of course, most famously developed the option pricing model, for which Scholes and Merton subsequently won a Nobel Prize. Unfortunately, Fisher Black had passed away by the time the prize was awarded. What's also really interesting about Booth is, again, our interest in answering questions. So this picture shows us, on the left, as I see it, Gene Farmer. And Gene, as I mentioned, won the Nobel Prize and is really known for his work on efficient capital markets. If you want to know what we mean by efficient capital markets, I've included that down the bottom of the slide. But what's most interesting about this picture is that on the right, we have Richard Thaler, also on our faculty, who in 2017 won a Nobel Prize for his work on behavioral economics. And if you go on YouTube, you can find this most interesting discussion between Gene and Richard, which is really about whether markets are efficient. If you know anything about behavioral economics, you'll know that Richard takes essentially the opposite view to Gene, and yet he's on our faculty. And why is that? Well, because again, we're interested in answering important economic problems and questions. So you want open debate. You want people challenging each other's ideas. So if you're in Gene Farmer's camp, understanding market efficiency, thinking about market efficiency, it's great to have someone who thinks very differently, such as Richard, to challenge those ideas and ultimately come up with what we hope is the right answer. So just to reinforce that a little bit, if you think about some of the modern ideas that we have in finance, those ideas were tested using data. And what really helped revolutionize finance, including here, was the development of the Center for Research in Securities Prices, which is known as CRISP. That began in 1960. And essentially what that effort involved was collecting security prices so that we had data to analyze economic questions. And without that data, we wouldn't have the work that Gene did in the 60s that was based on that data and testing, using data, the market efficiency ideas. Those ideas, by the way, are what led about 10 years later to what we see on the right here, which is the first index fund. The first index fund was developed by Mac McQuan at Wells Fargo, based on the ideas that came from his discussions at Booth with Gene, with Fisher Black, with Myron Scholes, and with other people. If you talk to Mac today, and I've talked to him a number of times, he really credits the work that came out of the analysis in the 60s and the efficient capital markets work with those first index funds, which, by the way, were then developed into the ideas that led to DFA, which of course is where David Booth made his money, which ultimately led to him naming the school. So the point of all of this is just to understand the reason that Chicago is so important in finance and economics is really these foundational ideas and this quest for knowledge, which is part of what we want to share in this program. One thing that I wanted to do, Tessa mentioned a case study. What I want to do today is spend a little bit of time talking to you about valuation. And specifically, one of the things I wanted to talk about is what happened with Starbucks, and use Starbucks as my case study. As some of you may know, Starbucks announced their second quarter earnings last night. As we see on this slide, Starbucks announced earnings that disappointed the market. So there was a negative earnings surprise, about 14%. So analysts had been expecting earnings of 79 cents. The company reported 68 cents per share. The company also downgraded its guidance. And so what we saw today was this. We saw the stock price go down roughly 16%. So it finished today at around $74. And this is exactly what you'd expect in an efficient market, right? The efficient market hypothesis says that markets respond quickly to new information. And so that's what happened today. We had negative news, market responded real quick. Now, what I'm interested in answering from a valuation standpoint, which is really the focus of the class, is if you look at Starbucks stock price right now, so as you see there, around $74 a share is where it ended at the close today in New York. Is that actually a buying opportunity? Some people might look at this big negative reaction and say, that's an overreaction to the news. Actually, Richard Thaler might say something like that, and that presents us with a buying opportunity. So one of the things we want to understand in this class is really about valuation and trying to figure out what is the fundamental intrinsic valuation of, say, in this case, shares of Starbucks common stock. Lots of other applications of valuation. As I mentioned, with Starbucks, we've seen the stock price decline from roughly $115 about a year ago to, as of today, less than $75, so down by 33% approximately. Another interesting example, right, is completely different context, which is professional sports. So as some of you may be aware, a year or so ago, the Washington Commanders, which is an NFL franchise in the US, was sold for about $6 billion US. Interestingly enough, around the same time, there was discussions about whether Manchester United, of course, the Premier League franchise in the UK, will be sold. And the price floated for Manchester United around the same time with $6 billion. So here again, just like the Starbucks example, we're interested in understanding if we think about a number, say, for $6 billion for the Commanders or for Man United, where does that number come from, right? If we were investing, someone presented this idea to us, do we think $6 billion is the right amount? Is that the value? Is that the price? Give you another example. This is from the Financial Times. And one of the things that has frustrated the gentleman I just showed you, who is the chief executive of Total, one of the major European oil companies, is what we see in this chart, which is that his company, Total Energy, is tracking down the bottom there. What I'm showing here is a chart taken out of the Wall Street Journal last summer. What it's showing you very clearly is that the price earnings ratios of both Total and BP and Shell, so three European-based oil companies, traded a discount to their US counterparts, being ExxonMobil and Chevron. And you can see that clearly by the price earnings multiples tracking lower for the three European oil-based companies versus the US one. So another question might be, are the US companies overvalued here? Conversely, are the European companies undervalued? How do we exactly answer that question? We need some kind of valuation methodology or approach. And that's really what the focus of the program is going to be. So what I want to do is just briefly run through what I would call the most rigorous type of valuation approach, which is a DCF approach, which some of you may already be familiar with. A DCF, simply put, just says that the value of any asset is the present value of the stream from now through infinity of the future net cash flows that asset throws off. So this somewhat intimidating looking formula here is really just saying that. It's saying that V0, which is the value today of any asset, is the present value of the cash flows that asset throws off from now through infinity, discounted at whatever the relevant discount rate is. And so that really brings us to the fundamental building blocks of doing valuation. And there are basically three key elements in any valuation. First of all, we have to forecast and figure out what those future cash flows are going to be. And a big part of the discussion in a valuation course, including the one that we're offering this summer, is how do you do that forecasting? Do you do free cash flows? Do you forecast earnings per share? You're going to have to forecast profitability in some sense. Second thing you're going to have to do is figure out the correct discount rate, which is really based on risk, and specifically the risk of both the business itself. So in the case I want to talk about, the risk of Starbucks business, primarily selling coffee through retail outlets, and then also the financial risk of the business, meaning how it's levered. And some of you will know that that discount rate is reflected in the underlying weighted average cost of capital of the business. And then the third element, which is really critical, is figuring out what the long run growth potential of the business is. And this is sort of the magical G that's there in any valuation approach. So to put the typical way we think of valuation in a little more of a formal sense, right? And again, we have this equation here, but the equation is actually very intuitive, right? What we're doing is simply saying the stock price today, P0, is the present value of the cash flows over some period of time. And think about cash flows, we might think about dividends per share. And so we're going to discount dividends per share. Now, in some companies don't pay dividends. So instead of doing that, we're going to typically throw in earnings per share. So we're going to forecast earnings over some period, and we're going to discount that by the relevant cost of capital. Right? So typically what we do is we explicitly forecast earnings over some horizon, might be 3, 4, 5 years. And then we figure out a so-called terminal value. And the way we get to the terminal value is essentially what we're doing is we're going to assume that at that terminal point, let's say it's year 4 into the future, we're going to make some assumption about the growth rate of those earnings or cash flows into perpetuity. And this is where this magical G comes in. This G becomes a critical element in valuation. Right? So what I want to do is just very quickly show you how we would actually implement this. And the example I'm going to use, I'm going to stop sharing my PDF. And what I'm hoping to do here is to see my Excel spreadsheet. So can everyone see my Excel? Okay, good. People are nodding, so that's good. So here is the Excel, right? And what we've got here is essentially what I just showed you. And specifically, I try and highlight some of these cells here. Specifically, what I'm doing is I'm taking earnings per share in the next year, so fiscal 2024, and hopefully you can see that's $4.01. Then for the next year, 465, for fiscal 26, 538, fiscal 27, 646. I'm taking these earnings per share estimates from analysts' consensus for those future years for Starbucks. And essentially what I'm doing is I'm applying a discount rate, and we can talk more about where that comes from, but I'm assuming that that's going to come from a typical asset pricing model based on an estimate of a risk-free rate and a beta and so on, and make some assumptions there. Cost of equity would not be unreasonable at 8.4%. And then what I'm going to do is I'm going to say, okay, I'm going to explicitly forecast earnings over the next 4 years. And then I'm going to go down here. I'm going to calculate a terminal value. And what I'm going to do is I'm going to take an earnings per share forecast at year 5, and I'm going to assume some growth rate G. Right? And essentially, those are the necessary ingredients for my valuation, my earnings per share forecasts over the next several years, assume discount rate, assume G. If I plug all of that stuff into my DCF, just calculating a present value there, right, I'm getting a stock price of around $138. I actually did this on the weekend before we saw the news last night. As you can see, the 138 number, right? Today's stock price, as I mentioned, is around $74. So that number seems too high. Right now, if I redo that today, based on analyst adjusted expectations based on the negative earnings news we had today, analysts have lowered their estimates, but not by that much. And so the stock price is still $132, still seems too high. And if you actually dig into this, what you find is that the numbers here are assuming that Starbucks earnings were going to grow at 18%, which seems just too high. What they told us today, based on their guidance, was that, in fact, earnings this year were not going to grow at all. Right? So if we make an assumption that instead of growing at 15, 16, 17% over the next 7 years, next few years, Starbucks earnings instead grow, say, at 4%, we can see that that drops the value to around $86, right? And the point of me showing this spreadsheet to you is just to show you that if I make different assumptions, let's say that I assume the cost of equity is not 8.4%, but say 11%, that has a big effect on the estimated stock price. Similarly, this long-run growth rate, this G, magical G number that I talked about, if I were to assume that was 2% rather than 4%, again, it has a big effect on the valuation, right? So this is the framework we use let me show you just another way of doing this. This is a spreadsheet, very similar spreadsheet, but instead of forecasting the earnings, now I'm forecasting the company's unlevered free cash flow, and I'm deriving from that ultimately the same share price value, right? And as you can see here, if I use this approach, which is a little different way of thinking about those future earnings and cash flows, again, using unlevered free cash flows as opposed to earnings per share, you end up with a similar discount rate, which is now the WACC, similar growth rate, 4%. You end up with a number around $78, which is not actually that far off where we saw the stock land today. The point of this, by the way, is not to suggest to you, and I'm not recommending you buy or sell Starbucks stock. The point of this is to show you the way we think about this in a relatively rigorous way using a DCF framework. Okay, let me jump out of that and jump back into the deck, and maybe we want to see if there are any questions or comments at this point before I talk a little bit more specifically about the program.
Yeah, there is one question in the chat asking about face value of debt or market value.
And whether we use the face value of debt or the market value of debt, was that the question?
Yes.
Yeah, so I assume that question had to do with what I was doing in terms of the unlevered free cash flow, and the answer would be what we want to be doing here is estimating the economic value or market value, and so ideally we would use the market value of the debt rather than the book value of the debt. Although in many instances, those numbers are going to be quite similar. So in some situations, we can talk more about the specifics of this, but in some situations, the book value and the market value of the debt is going to be quite similar. The market value and the book value of the equity, however, the book value being the number you see on the balance sheet for accounting purposes in the annual report versus the market capitalization of the company, those numbers are going to be actually quite different. Okay, so let me jump back into my deck here and talk a little more specifically about the program itself. Okay, there we are. And so the program is, as I mentioned, really a mix of theory and practical applications, right? What we want you to do and to take from the program is both a valuation methodology and framework, but also applying that in a real world way, right? Which is consistent with the way we think about really our research at Booth, which is let's take some theory and let's apply it to the real world. And just to get in some specifics of the program and who's teaching in it, I'm going to be teaching the first day. The first day is really going to be about foundations of valuation, including the DCF approach that I talked about, or approaches. There are multiple implementations of DCFs. We'll talk about multiples approaches, comparables approaches, talking about risk and discount rates, talking about the earnings input, earnings quality analysis, and so on. And again, some kind of case application. One thing I'm super excited about in the program is the colleagues that I've encouraged and been able to secure to teach in the program. On Tuesday, the program is going to be taught by Haresh Sapra. Haresh is one of our superstar teachers. He's won every teaching prize we have, in some cases multiple times. He is an intense guy who really delivers fantastic content. And what he's designed for this program is really to talk about some of the nuts and bolts of how deals get structured, meaning M&A deals, restructuring deals, sales. So all of these elements of the program are going to be applications of valuation in a specific applied context. So Haresh is going to talk about this in the context of M&A structuring. Wednesday, I'm super excited. We're going to have Amir Sufi. Amir is one of my younger tenured colleagues. He won several years ago the Fisher Black Prize in finance, which is really for the most outstanding finance research by a researcher under 40 years old. So really, it's a precursor, if you like, of someone who's done work that is just incredibly highly recognized by the profession. So Amir, in addition to being a superstar researcher, is a fantastic teacher. He specializes in what I'd call leverage finance. And what he's going to talk about is high yield financing, highly leveraged transaction, distressed situations, which is where you often see high yield debt being applied, and the use of leverage and highly leveraged loans in structuring deals like LBOs. So really it's going to be around the debt side of the equation as opposed to the equity side of the equation. And this is what he teaches in our MBA program. He has a highly popular elective on this topic, and I've asked him to bring a day of that into this program. And then the final piece of the program I'm also super excited about. This is Steve Kaplan, my colleague. If you don't know about Steve, Steve is the one who has, over the last 20 or 30 years, driven what is a highly successful entrepreneurship and private equity program at Booth, developed our Polsky Center. Steve doesn't usually teach exec ed, but he agreed to do it here and really teach a day on what he really is interested in, which is private equity and private equity investing. The gentleman down the bottom, Nick Alexis, Nick is a Booth grad who has spent some time in private equity investing, but for the last several years was or is still a CFO of an entity called Univar Solutions. Univar was a public company which in the relatively recent past, early last year, was acquired by Apollo, of course, a major private equity firm, in a deal worth around $8 billion. And so Steve is going to talk about private equity, but really Nick and Steve are going to spend the afternoon talking about how that deal was put together, how the valuation was done, how all of the different elements were structured in the deal. And I was actually on a call with Nick this afternoon to talk about the program. He is very excited about teaching in the program. So I think that is going to be another tremendously interesting day. Let me just skip over this. This is a summary of the key takeaways. In terms of the people that we think of as attending this program, it's really anyone, and you can read what's in the screen here, but anyone in any part of the capital markets, right? Whether you're in a corporate entity, whether you're on the buy side, whether you're on the sell side, whether you're an investment manager, anyone who does valuation in any context. So we're thinking about valuation very broadly here. Let me close by saying a couple of things. We are expecting you to have some background in finance, so some understanding of concepts like NPV calculations, which is really just present value calculations, weighted average cost of capital, internal rate of return, and so on, through professional experience or any other program. Let me stop there and hand it back to Tessa and the others in the team. But certainly I'm happy to take some questions at the end.
Wonderful. Thank you so much, Doug. And we look forward to hopefully answering your questions related to program content or any of the other materials that Doug mentioned during his section. So now we would love to move into the application process and to describe a couple of the program benefits that you all will hopefully get to experience. So Chicago Booth, as we've been saying throughout the whole information session, is that it's a global institution offering a truly global experience, and that starts with our campuses. So we are the first and only business school to have permanent campuses on all three continents of Asia, Europe, and North America. So our primary campus that most of us are logging in from today is Chicago. And so we have our Gleacher Center right off the river in Chicago. We also have our London campus, which is located in the heart of the city. And then we have our newest campus, which is Hong Kong. And it's a very exciting opportunity that will have offerings at all three campuses too. So the program, like I said, is run on all three campuses. So our next upcoming sessions and dates are in Chicago first. It'll be July 15th through the 18th. And then it'll be in Hong Kong, November 25th through the 28th. And then lastly, we'll have our program in London next year, April 7th through the 10th, 2025. So in order to apply for the program, candidates must submit a completed application. This is all done online through our website. And then after your application is submitted, it will be reviewed and hopefully approved by Booth staff within 7 business days. So you'll hear back from us pretty quick that way too. And so what the actual application is, takes about 15 to 20 minutes to complete, and it has the following questions on this slide. So the required questions are a yes or no question, so pretty quick to get through those, talking about that background experience that Doug mentioned. And then we also have a couple of optional questions too for you to give us more information about what you're really looking forward to in the program, what your background is, so we can help make the classroom as conducive to your learning as possible. And so next I'll have my colleague Rebecca talk about other benefits and exciting information about registering for the program.
Thank you, Tessa. Yeah, so if you're ready to apply, you'll find that there are financial benefits if you register and pay the tuition early. For our July offering in Chicago, you'll see here we highly recommend that you register before June 1st to take advantage of these financial savings. We've also included the deadlines for our other program offerings here. And please note, when you submit the application online, our registration system will automatically apply the discount. To maximize learning, we also think this is a great program for a team to attend. If you're interested in attending with several members of your team, we do offer group enrollment benefits. Maria, Tessa, and I would be happy to share more details, so please reach out to us after this presentation if you're interested in learning more about that. And upon fulfilling the program's requirements, this is just a look at some of the program benefits. So you'll receive a certificate of completion from the University of Chicago Booth School of Business, a mark of your dedication and success in advancing your financial leadership skills. You'll also receive a digital badge credential, a modern representation of your achievement that can be displayed across your professional online profiles, such as LinkedIn, to showcase your expertise to your network and potential employers. And completing the program also brings the esteemed status of past participant in executive education, connecting you with Booth's expansive network of over 31,000 executives spanning 140 countries. This certificate of completion is not just a testament to your learning, but also a gateway to an exclusive community of professionals offering continual opportunities for networking and professional development. With Chicago Booth past participant status comes benefits such as networking opportunities at our flagship symposiums, such as the Economic Outlook and the Booth Management Conference that's offered each year, an invitation to join our private LinkedIn group, and access to research, analysis, and perspectives of our faculty and premier business scholars through both our Executive Insights newsletter as well as the Chicago Booth Review, which is the official publication of the business school. And now I'd like to give the floor to my colleague Maria, who will share more information about our Global Advanced Finance program. As you'll learn, the Accelerated Valuation program is just one of the programs that can be included in this highly customizable certificate program.
Thanks, Rebecca. So as everyone mentioned, I'm Maria Sierra Wilburn, and I work on the enrollments for the finance programs, the Accelerated Valuation program, as well as the new Global Advanced Finance program. And so we're really excited to introduce the new program. It's a distinctive opportunity that combines the prestige of Chicago Booth alumni status with world-class education. The program is tailored for senior executives, and it provides a stepping stone for leaders eager to propel their organizations and their own capabilities in strategic financial decision-making. With a curriculum designed to meet you where you are, the program offers 6 finance and strategy program electives to be completed over 2 years, providing flexibility to deepen your finance and strategy acumen. The heart of the Global Advanced Finance program lies in its cutting-edge curriculum. We focus on an interdisciplinary approach, merging finance with broader management principles to shape you into a well-rounded leader. The program allows you to refine your analytical skills, providing you with necessary frameworks and tools for effective mergers, acquisitions, and corporate restructuring. You'll also learn to drive value and enhance performance within your organization using advanced skills in capital markets, corporate finance, and sustainable growth strategies. You'll stay at the forefront of finance with the latest strategies and best practices in investments and portfolio management, ensuring that your knowledge remains relevant. Ultimately, this program is about transformation, transforming you into a strategic leader who can align financial goals with broader business objectives, driving innovation and strategy within your organization. So the Global Advanced Finance program offers a unique curriculum that's specifically tailored to address the development needs of each leader. You customize your learning, ensuring that your educational experience directly benefits your career trajectory. Understanding the demanding schedules of senior executives, the program provides a modular and flexible format. So it's designed to fit seamlessly into your professional life, requiring minimal time away from your workplace. Electives are generally offered in 1-week intervals. Our program structure allows for the immediate application of new skills. You'll be able to put into practice what you've learned between sessions, ensuring continuous professional development. You'll also experience the Chicago approach to business and finance, our acclaimed, multidisciplined, and collaborative framework that prepares you to address complex issues with innovative solutions on a global scale. With sessions in major financial hubs like Chicago, London, and Hong Kong, you'll join a network of industry leaders and peers from across the globe, enhancing your learning with diverse perspectives and experiences. Our program equips you with financial tools and methodologies vital for high-stakes decision-making. This not only reignites your career, but also ensures you're well-rounded in financial expertise and equipped to make exceptional impact in any industry around the world. And perhaps most notably, when you complete the Global Advanced Finance program, you will earn the coveted Chicago Booth alumni status, which will align you with some of the most influential leaders in the business world today. This is more than a credential. You gain lifelong Chicago Booth alumni status, joining a powerful global network of influencers that includes CFOs, senior investment professionals, and C-suite executives, a testament to the strength and influence of the Booth alumni community. Your new status opens the door to membership in exclusive Chicago Booth alumni clubs around the world, facilitating unparalleled networking and professional opportunities. And as part of our commitment to you and your continuous development, you'll enjoy alumni discounts for select executive education programs and benefit from exclusive alumni resources, such as a dedicated email address, access to our private LinkedIn group, and professional development services. You'll also receive invitations to attend Chicago Booth community events and enjoy the privilege of booking space at our Chicago Booth campuses at special rates, offering you a prime location for your professional events and meetings. And at the heart of our admissions process is a holistic approach that values not just your achievements, but also your potential contribution to the Chicago Booth community and your alignment with our educational approach. We consider your career progression and achievements, looking for leaders who have demonstrated significant impact in their fields. We seek dedicated professionals who are eager to engage with the curriculum and apply their knowledge. We look for candidates who share our values of inquiry, insight, and impact. The ability to contribute to the Booth community is also essential. We value diverse perspectives and experiences that enrich our collaborative learning environment. We encourage you to complete the online application to apply to this prestigious certificate program. We accept and review applications on a rolling basis, allowing for flexible admission throughout the year. And as mentioned, the Accelerated Valuation Program is a Global Advanced Finance Program elective. You can receive credit for it as one of your electives and get a head start on completing the Global Advanced Finance Program. And now Tessa will discuss the next steps with you.
Thank you, Maria. And thank you all for the time and attention today so far. Before we wrap up and go into our question and answer section of the day, I would like to discuss those next steps of what to do after the information session today. So, firstly, if you haven't already done so, I encourage you to visit our program's website. There you'll find detailed information about the application process, program requirements, and program dates. So you can go ahead and scan those QR codes if you wanted to have those websites easily accessible on your phone. And once you have decided which program location and dates best fit your needs, you can fill out the online application and submit it within 7 days of starting it, just to save all your progress. After your application is approved by Booth personnel, you will start hearing from us 6 weeks before your program regarding travel logistics, pre-reading materials, and other important pre-program information. As always, you can feel free to always reach out to us with any questions or concerns that you have. If you have general questions, you can reach out to the exec.ed@chicagobooth.edu email address, or you can contact any of us at any of our specific email addresses included in this presentation, which again will be sent out after the information session along with the recording of today. So at this time, I welcome you all to turn on your cameras for our question and answer section. And if we're unable to answer your questions now, we'll definitely get to them at a later time too. And again, if you wanted to ask a question through the chat function, you can do that as well. And myself or Rebecca will read that question out loud for the whole group. Give everyone about 30 more seconds to see if they are typing. I know I'm a slow typer, so I just wanted to make sure giving everybody enough time. And I'll keep my chat open, which I'll open right now, just to make sure we have all of them. Okay, perfect. Looks like we have our first question through the chat. Will we cover other valuation methods, such as relative valuation? Doug, I believe that question is best suited for you.
Simple answer, yes, absolutely. We will cover the whole range of different valuation questions. I skipped over this pretty quickly, but we will talk about different DCF-based approaches. In some ways, DCF is the most rigorous, But then there are other, as you mentioned, I think relative valuation approaches. There are multiples approaches, comparable firms, comparable transactions. So yes, valuation is not a precise science. So in valuing most valuation contexts, we want to run the valuation in a number of different ways, number of different types of assumptions. So yes, absolutely, we will do the gamut of different valuation approaches and methods.
Great, thank you. That was a great first question. Any other questions out there related to registering for either one of our programs, either the Accelerated Valuation Program or the Global Advanced Finance Program? The logistics of while you are on campus, how that program works, especially for those of you that maybe have never been to Booth or haven't been to Chicago, London, or Hong Kong on our other campuses as well. Okay, so it looks like I do have one more question, asking about more information about the start and end times of the upcoming Chicago program, information about, where people from out of town typically stay, and what a typical day looks like at a program for executive education at Booth. So Rebecca, would you be able to answer that question for us?
Sure. Yeah, so for the program in Chicago in July, we'll kick off at 8:30 on Monday and we'll finish by 5 p.m. on Thursday. And that's kind of the typical schedule for the week. We will have several evening social events too to facilitate networking opportunities. We also at the Gleacher Center provide shared lunches too. That is a great way to continue to get to know your fellow participants. And typically too, you'll have group work each day during the program where you'll get to work with different people from your class. Being that it's held at the Gleacher Center campus, we do work with the Intercontinental Hotel specifically to negotiate a discounted rate, but the Gleacher Center is within walking distance of a number of great hotels. The Intercontinental happens to be less than a 5-minute walk, so it's very convenient for going to class. Yeah, so I hope that helps give you a sense for the week and the location.
Great, thank you so much, Rebecca. So that's all the questions I have right now in my chat. Does anybody want to ask 1 or 2 last-minute questions, either by just unmuting yourself or by typing something in the chat?
Doug, I had one question, which is, we might be entering an environment where inflation is just higher.
Yeah.
Will you be talking about inflation impacts on valuation and how to think through that?
Yeah, absolutely. I mean, it's interesting because probably the last 10 or 15 years, it's been kind of a non-issue because inflation has been so persistent and so low. But yeah, we specifically talk about it. And so for example, the growth rate that I showed you on that spreadsheet, typically the way we would factor in inflation is all of the numbers we would be putting into those DCF models would be nominal numbers, right? So if I'm forecasting earnings, I start by forecasting the top line revenues, and then I would build into that some assumptions of inflation. The discount rate as well would then reflect inflation expectations. So yeah, we will talk about that and many other real world complications.
So growth rate goes up, cost of capital goes up, and you'll walk us through that. Okay.
Correct. And yeah, I won't get into the specifics of it as much as I would like to, but yeah, we will certainly talk about that.
Thank you.
Yeah, great question, John. So, Rebecca, I'm not sure if you have any more questions, but I think, we're right on time at 8 p.m. Chicago time here. So, us here at Chicago will stay on for a minute or two just to make sure there's no last minute lingering questions. But otherwise, thank you all for joining us today. And we look forward to hopefully engaging with you in the future and potentially seeing you on campus in Chicago, July 15th through the 18th.